Good morning, good afternoon, good evening, and thank you guys once again for joining the 9 Innings podcast hosted by yours truly, Kevin Thompson, founder and CEO of 9i Capital Group. Thank you guys for joining us. As I always say, subscribe to this channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions, or you can go to the website at www.9icapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage. Before you do that, make sure you subscribe to the 9 Innings podcast on YouTube, on Apple, iTunes, SoundCloud, Pandora, anywhere you get your iTunes, anywhere you get your podcast. We'd love to have you subscribe. So today we're talking finance. Big things happening in the markets. Big things happening across overseas. And you know what? What's not being missed is the 10-year just top 4%. The 10-year just top 4%. Today we're discussing what that means for your money. Let's get it. So if you've been under a rock, you may have not noticed what the interest rate environment looks like at this time. We know that the Fed is increasing rates consistently over the past 13, 14 months from 0 all the way up near 5%. So what does that mean? Well, that basically means that borrowing costs go up. That basically means that variable interest rates go up. That also means that it's more difficult to get access to capital, which basically means they are trying to remove money from the economy and reduce the inflationary pressures. The question, my friends, is it actually working? Well, if you look at it year over year, inflation actually is trending in the right direction, but it's not trending fast enough in the right direction. So people are prognosticating, like myself, well, will the Fed continue their hawkish interest rate stance? And it's looking that way. It's looking like they're going to go another 25, possibly 50 at the next meeting, which is going to take them over their projected target. Some people are expecting the interest rates to stop somewhere near 6% when the Fed was saying we're going to be closer to 5.1. What's funny about this is they've missed this projection before. You guys remember that back 2 or 3 years ago, they're saying we're going to be somewhere in the 3s. And now we're on the 4s into the 5s, possibly into the 6s. So what that means? Well, we just saw this. The 30-year note on a house is over 7% again. It's not stopping people from buying homes. No. But it's definitely making it more difficult for everyone to buy homes, like my man Johnny Collins from Community National said last week. So what's important to understand about this here on the 9 Innings podcast, and thank you for joining us, is that things are absolutely changing. And where they're changing is in what we call the yield curve. 4% 10-year yields? Wow. Who would have thought it? People back in the 80s were like, 4%? Man, I'm getting 5, 6. What is 4%? But now we are lucky and happy to get that 4%, especially for 10 years, especially when we think rates are going to be falling in the future. So today, which is as of the very beginning of March, yes, rates have crept over, especially in the 10-year, have gone up over 4%. On the front end, the 30, 60, 90 days treasuries have gone over 5%. Wow. That looks so good. So the issue with the markets right now is this. This is what they're having to battle with. If I'm an investor, which I am, and I'm going to put money towards the stock market or equities, I have to find something that's going to give me a risk-adjusted return that's higher than what either the 30, 60, 90 days going to put, my cash bucket's going to give me, or what the 10-year yield's going to give me. Do I realistically think that I can get 4% plus over a 10-year period? And at what risk am I willing to take? So you have to ask yourself, okay, I can lock in 4% today for a 10-year period. This is as an investor, by the way, a long-term investor. I know I can get 4% here. I know it. As long as the government doesn't default, I know I can get 4% in the 10 years. So what does that mean for my equity investments? My equity investments have to give me 4% plus based on how much risk they have towards the market and how much higher the risk-free rate actually may be going. So if I'm an investor, and let's just say my beta, my market risk is say 1, and my expected return from my security is say 7, and I'm not saying you're going to get 7. I'm not saying that. No. But let's just say the average return over a 30-year period is roughly 7%. And who knows what, it could be 6, it could be 5, but let's just use the number 7. And the risk-free rate is 4. So the capital asset pricing model, I'm not trying to get too nerdy on you. Let's just say my risk is 1. So if I say, okay, 7 minus 4 is 3 times 1 is 1, plus if I add back in the risk-free rate, which is 4, I have to get 7%. I have to get 7% risk-adjusted returns to just satisfy the fact that I'm foregoing my 4. The reality is a 7% maybe versus a 4% absolutely, quote unquote, as long as the government doesn't default, is a tougher pill to swallow. What's even going to be more of a tougher pill to swallow is the fact that what if it goes to 5? Then that 7 becomes 8, 9, or 10, depending on what your expected return is going to be. So to put it in context here is this: am I willing to take a risky 6 or 7% when there's things over here on the other side of the fence that are giving me 4 or 5%? Most investors would say, no, I'm pulling my money from the market and I'm stacking it over here until things kind of settle down. And that's what you're seeing currently when the markets are coming down, because people are taking money out of stocks, going more into safer assets, because those safer assets are yielding a higher return. Simple as that. So thank you guys for joining the 980s podcast. Today, we talked about that 4% yield, that 4% 10-year, and why it is bringing down the stock market. In addition to that, on top of getting the risk-adjusted returns in other asset classes that you're going to have to get far and beyond the risk-free rate of, say, 4 or 5%, whichever yield you're looking at the time. When we're looking at the front end of the curve, because the front end of the curve, which is those 30-day, 60-day, 90-day, 3, 6, 9 months treasuries, a year treasuries, those are yielding, most of those are yielding over at 5%. So what a lot of investors are doing, they're saying, why am I taking risk right now? Again, the market's going to may get clobbered, may go down. I'm going to put money over here in these treasuries and just wait this out. Now, we are not market timers. We don't believe in market timing. No. But we do believe in efficiency. We do believe in efficiency and safety. We want to get as much return per level of risk that we're willing to take as investors. Our clients preach that as much return per level of risk that we're taking. So if there's an opportunity for us to remove risk from our portfolio and to receive compensation or return for that, even though the Fed's going to say, well, we're putting it to a more inefficient vehicle out of equities and into just safety, be that as it may, it's efficient for me as the investor to feel like I can sleep at night. That's what we do here. That's what we do. We want to help people sleep at night here at 9i Capital. Thank you guys for joining us. As I always say, subscribe to this channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. Any questions, comments, or concerns, go to info@9icapitalgroup.com. Send us a question or go to our website, www.9icapitalgroup.com. Subscribe to this channel. It's on all of the different YouTube, iTunes, SoundCloud, Pandora. Listen to this station because we love to hear what you have to say. Put your comments in there as well. You won't hurt our feelings. Thank you. As you know, we're here to do what? Educate, empower, engage. And I hope the 980s podcast educated you today. Thank you. Enjoy your day. We'll see you next week.